Here's something strange on the surface. The big indexes keep printing record highs. The headline number is green. Everyone says the market is strong. But look one layer down and a different picture shows up. Most individual stocks are actually flat or falling. So how can the index be at a record while the market underneath it is weakening? That contradiction is the whole story, and it has a name. We're not calling a top, and we're not predicting a crash. We're going to walk the mechanism, so the next time you see a record headline, you know what to actually check. Start with the thing that explains it: market breadth. Breadth is simply how many stocks actually take part in a move. When a rally is broad, hundreds of names are rising together, advancers crush decliners, and the whole field is participating. When breadth is narrow, only a handful of stocks are going up, while most are quietly going down. Now here's the trick. The headline indexes you hear quoted are cap-weighted, which means the biggest companies count the most. So a few enormous winners, the mega-cap group people nicknamed the Magnificent Seven, can drag the index to a record, even as the majority of stocks sag. Broad breadth is a healthy, participating market. Narrow breadth is a few names doing all the lifting. So, who are those few names doing the lifting? Picture the index broken into tiles, each one sized by how much it weighs. A small cluster of mega-cap technology companies. The group people nicknamed the Magnificent Seven has grown so large that, illustratively, just a handful of names can account for something like a third of the entire index. That's the concentration cliff. The other 490-odd companies share what's left. When that tiny group rises, the whole index looks great. When it stumbles, there's almost nothing underneath to hold the number up. The record isn't really the market. It's a few giants wearing the market's name. Now watch what money does. After a long run, those mega-cap leaders get expensive, and at some point in 2026, their leadership hit a roadblock. Part of the story is what you might call AI fatigue. Investors stop rewarding everyone who can build artificial intelligence and start asking the harder question of who can actually run it at a profit, given the enormous energy and compute costs. So capital starts rotating. Money quietly leaves the crowded high-valuation growth names and moves toward other corners of the market that got left behind. Rotation isn't a crash, it's a reshuffling. But while it happens, the old leaders wobble, and because they are the index feels it. Here's why narrow leadership tends to be fragile, and this is the heart of it. When breadth is wide, the market is like a roof held up by hundreds of pillars. Knock a few out and it still stands. When breadth is narrow, that same roof is balanced on just a handful of giant columns. The structure can look perfectly fine, even hit new highs, right up until one of those columns wobbles. That's the divergence. The index says strong, the participation underneath says weak. And the wider that gap gets, the more the whole thing leans on a few names. Now, to be honest and careful, narrow breadth is not a timing signal, and it is not a crash prediction. Markets have stayed narrow for a long time before. It is a description of fragility, not a countdown. So here's the takeaway you can actually use. Go back to where we started, the record headline that says the market is strong. Now you have the layer underneath to read it with. Breadth is the answer to the question we opened with. Ask, how many stocks are really participating? If a record is being carried by a shrinking handful of giants like the Magnificent Seven while most stocks fall, the number can be real and the foundation can still be narrowing at the same time. That's not a reason to panic, and it's not a forecast. Markets can stay narrow for a long while. It's simply a sharper way to see, and none of this is advice. So when the next record headline cheers, here's the whole lesson in 2 lines. Watch the breadth.